This week's signal is all about GDP. India's economy grew in the first quarter of financial year 2026, and please stay with me because it's just not a statistic. It's a saga that we will unfold together in next few minutes. The headline: the economy grew 7.8% year on year, the fastest in 5 quarters and well ahead of the RBI's projection of 6.5% and the consensus estimate of 6.7%. Welcome back to Signal, where noisy markets meet simple, sharp and sound insights for long-term investors. The markets for the week ending 29th August 2025 had a mixed week. They started strong but ended under pressure. The Sensex closed at 79,810 points, down by about 1,500 points from last week's close. The Nifty closed around 24,427 points on Friday, nearly 450 points lower than last week's close. US tariffs continued to print pressure on the markets. IT and realty led early gains, but by week's close it was FMCG and consumption-driven stocks that showed resilience. Foreign investors pulled out about $3.3 billion in August, the sharpest monthly outflow since February. The rupee touched a record low near 88 rupees per US dollar, prompting RBI intervention. Overall, a week that started with optimism ended at a cautious note as global tariffs and foreign outflows weighed on the sentiment. For investors, this means keeping an eye on defensive sectors like FMCG and pharma, while being patient with cyclical sectors until global uncertainty eases. Every quarter, when India's GDP number comes out, the headlines scream 6.5%, 7%, 8%. But the real question is, what do these numbers mean for investors and why are they important? Let's decode this in Strategy of the Week. GDP is like India's financial report card. It shows the total value of goods and services produced in a quarter or a year. And when you hear these numbers, 6.5%, 7%, remember they are year-on-year growth rates, which means the economy is being compared with same quarter of last year, not just previous 3 months. This helps you see the bigger picture. But why should investors care? Because GDP tells us the health of economy. A strong GDP means businesses are producing more, they are selling more, consumers are spending more, jobs are being created, and the overall confidence in the economy is rising. A weaker GDP, on the other hand, signals a slowdown, which means businesses may face weaker demands, pressured profits, jobs and wages might become stagnant. For investors, this could serve as a backdrop to decide whether to take more risk or play safe. Now, this is an interesting one. Does a high GDP always mean that stock markets will rise? Not always. GDP is backward looking, which means it tells us what happened in the past, whereas markets move on expectations. So if GDP is better than expected, then stock markets will rise. Whereas if GDP is worse than expected, then markets will fall, even if that growth is positive. So the next obvious question is, what should investors look for in GDP numbers? Consumption, investment, and exports. Consumption means how much people are spending, and a higher consumption number is usually beneficial for sectors like FMCG, autos, and retail. Investment reflects how much businesses and the government are building. A higher investment number usually boosts sectors like banks, infrastructure, cement, and steel. Exports capture how much is India selling abroad. A strong export supports IT, pharma, and textiles. Think of GDP as your investing compass, When GDP is strong, cyclical sectors like banks, infrastructure, and autos tend to get a boost. And when GDP is weak, defensive sectors like IT, FMCG, and pharma provide the stability. For mutual fund investors, expansionary GDP phases favor equity funds. Slower growth phases suit hybrid funds, and uncertain times make debt funds more relevant. But for long-term investors, GDP numbers matter in a different way. If India keeps growing by 6 to 7% plus, then businesses will grow, markets will grow, and earnings will grow. And that is the real signal to remain invested for long term. This was underscored in yesterday's GDP at 7.8%, which signals a strong momentum for short-term investors and reinforces conviction for the long-term investors. GDP is not just a number. It is a signal of where India's growth pulses. If you know how to decode it, you know how to align your investments. For story of the week, let's go to Surat, India's textile hub. In a small shop stacked high with saris and fabrics, the owner, Jigneshbhai, waits for his customers. For him, GDP is not about numbers like 6.5% or 7%. It's about how many families will walk through his doors during this festive season. In September 2024, India's GDP growth slipped to 5.4%, weakest in last 7 quarters. For shopkeepers like Jigneshbhai, it meant that weddings were postponed, household budgets were cut, sales were slow, and margins shrank. Every empty hour in the shop felt heavier than negative news headlines. But in the very next quarter, GDP rebounded to 6.2%. This improvement signaled that customers started to spend again. For him, this meant hope, new orders, new design in stock, and maybe hire an extra helper. For Jigneshbhai, the real measure of growth is not in charts, reports, and numbers, but in the number of footsteps at his door and saris leaving the shelf. And that's where the true heartbeat of India's economy is felt. And if Jigneshbhai decoded the recently released GDP growth of 7.8%, he'd probably smile and say, "Dhando saro chalse Diwali ma." Quoting Raghuram Rajan, growth is not just about numbers. It is about the quality of life of our people. And that's such an important reminder. GDP is just not for policymakers and economists. It's for the businesses that run our economy, for the jobs that sustain our families, and the aspirations of people across India. We are building a strong community of growth-oriented, goal-focused, and greedy long-term investors. If you're one of them, why not like and subscribe us and tell us in comments, do you see GDP as heartbeat of India?